some of their estimates for world growth, or world slowdown is probably a better way to put it, contraction. So there's a ton of stuff to cover, not to mention something you and I were talking about before we hopped on here, and that is the potential issuance of another $1 billion of share from Hertz. So maybe after we go through disclosures, we'll hit on that one right away, because that one's fresh on my mind. All right, disclosures. Guys, ladies and gentlemen, anything that Rob and I talk about, or just in general, anything that you hear on Schwab Live Daily, is really here for informational purposes only, educational purposes only. We like to talk markets. That's what we do. I have a background in options trading from trading in the equity options pits in Chicago. Rob does a lot of the analysis that you read daily from the Market Outlook and the market analysis sections from the Schwab Center for Financial Research. So basically, this is what we do. We talk markets, we study markets, we look at markets, and we like to share that information with you. That being said, make sure you get your questions in. Can't answer a question if I can't see the question. So, right there in the middle of the page, you will see an area for you to enter those questions in. I would be thrilled to answer a lot of questions today, because I think, given the week that we've had, I know I got a lot of questions, Rob. Maybe you can help answer some of those for me. Right. I'm assuming some of our viewers do as well, too. I don't know, Rob, do you think we have all the answers, or at least maybe we have a couple of them and can point some people in the right direction? But we'll get to that.
We got a few.
We got a few, exactly. Yeah. So like I said, in terms of our agenda today, we're going to kick it off with a bit of a market recap, go through some of the charts. I do think it's important as we look at some of the sectors as well. I want to talk about where the money went in, where the money went out in terms of performance this week. And then we're going to send it over to Rob, and Rob's going to kind of give us his take from the macro world in terms of the important economic news that came out this week, what you should be paying attention to, not only domestically, but also internationally. Because they got a full docket next week as well, too. Plenty to talk about. And then last but not least, get your questions in. We're going to analyze maybe some individual names as well, too, if we get a chance to do that. But let's kick it off. Look at the markets. All right. You can see I have the Russell up here first. I'll get to that momentarily, but I do want to take a look at the S&P. Rob and I were looking at the Russell just because we were kind of looking to see, maybe where the bounce was there and how that was lining up with some of the other markets. But, we did promise you a little bit of a look at Hertz. I want to start off, Rob. Normally we don't talk individual names like this, but this morning's story comes out that Hertz is basically looking to be able to offer up $1 billion worth of common stock shares to the market, right? And use maybe some of that while they're going through the bankruptcy proceedings. Now remember, they're still going through bankruptcy proceedings, right? They have filed bankruptcy. This is not in advance of, or here's our last ditch or our last ditch effort before we enter into bankruptcy proceedings. They've already announced that they are declaring bankruptcy, and they are looking for a federal bankruptcy judge to allow them to issue $1 billion worth of shares. Now, up until this morning, if you looked at the market cap of the stock itself, it was around 400 million. And that's given the bounce that we've seen, since the 40-cent low that it put in. It was trading at around a $400 million market cap. So basically, what in essence they are asking, and you tell me whether or not I am maybe overreaching a little bit when I say this, but basically they're saying, hey, investor, what we want you to do is front us the value of 2.5 times our company at this current level. We want to do that knowing, with you full well knowing the risks inherent of being a common shareholder, meaning that you're going to be behind the debt holders, the debentures, the secured debt. All that stuff is going to be in front of you in line when people start to come and say, okay, well, you need to divest that asset and divest that asset and divest that asset, and what's left over, you're going to be behind all those debt holders in order to recoup some of that money should these proceedings continue to go forward. But we're going to have one last ditch effort to try to raise some capital. And when I look and I see the stock's up 42% today, 87 cents or 42%. My question to you, Rob, is what am I missing here?
Yeah, I'm with you. I've never seen this before in my time here. Yeah, even before this morning, you see that rally. Investors or traders, I should say, have been, buying it up there, even though they, like you had mentioned, they did file for, bankruptcy protection, and just goes to show that there might be some new investors out there that might not understand, like you had talked about, the pecking order as far as when the bankruptcy proceedings get paid out. So yeah, it's something I've never seen before, and it's pretty shocking.
Yeah, it's shocking, and I think you kind of hit the nail on the head when you said traders versus investors, because at this point this is a tradable stock. It's tradable in that, as an investor, you got to understand what the risks are buying potential, right? Because we don't know whether or not this is going to go through, but the potential for having an additional 2.5 times the value of the company now float in terms of the shares out there on the market, $1 billion worth of shares being floated out there on the market. What do you think that does to the current shareholders, right? That reduces the residual value of their current holdings. Not to mention, as we did, that if this company is broken apart, or if it does dissolve at some point, you are further down the line from the secured bondholders, the unsecured bondholders, the debentures, all the the preferred stockholders, everybody in line. But yet we're pushing this thing up 42% today. Don't know. Just wanted to bring that one out there, just in case some of you had seen some of this news today. I just kind of wanted to have a chance for Rob and I at least to weigh in on this one. But interesting enough, there's some comments coming in here. Okay. Some comments coming in that, okay, look, it's a debt arbitrage trade going on where they short the stock and go long the debt. Well, that's normally what you do here. Okay, so this is coming in, I believe, from Kevin in Colorado. It says, I'm hearing that the reason for the stock moving is that the market makers and the hedge funds were doing a debt arbitrage trade by shorting the stock and going long the debt. Well, that would make sense, right? I mean, that's traditionally what you do. I mean, that's what they did in the 80s, right? When you look at the movie Wall Street and you see all the kind of the barons of the 80s where they were raiding corporate debt structures and the Milkins and all those guys. I mean, that is in essence what they were doing, was buying up the debt, shorting the stock, and using it as an arbitrage play. But that's a little bit different in my opinion than what we're seeing right now. And so basically, Kevin's saying, well, the arbitrage trade it's not too small to make it worth it for the larger funds, so they're stepping in, and the algos got squeezed out by the retail investors, and that's why you're seeing the stock pop. Maybe there's a possibility there. There's a possibility there, but I just I don't know. I just don't know. I think I think this is one of those where think about just the balance sheet real quick of Hertz, right? I mean, and the way it works, and I'm not trying to pick on this stock by any means, because I mean we can look at just the travel industry in general, and what's going on. Take a look at American Airlines, take a look at United Airlines. I mean, these were stocks that had popped off these bottoms and had huge runs, 20 back to 50 before pulling back to 30, 33 yesterday. American Airlines, once again, let's take a look at that one. Traded down to $8, ran up to 24. So you had a threefold move in a month, right? You got these huge moves. And, Rob, you and I talked about this last week, this idea of that, a lot of these market movements that we've seen recently have been done in stages, right? The phase one has been, the toxic assets that nobody wanted, the energy stocks, all that stuff that was, these zombie companies that have been beaten up so much, people started to dip their toe and say, hey, there's some value here. Or maybe even if it's not value, at least it's tradable in that, it's probably overdone. Let's see if we get a little bounce. And we saw that. And you saw that initial bounce. The money kind of moved out of that into the more of the stay-at-home culture names, your Zoom Medias, your DocuSigns, right? Your Amazons, the companies that are doing well in that current work from home environment. And then, phase three was, okay, well, what's left? Let's take a look at some of the sectors that haven't participated in the move. And so we talked about that last week. I don't know to me, it seems like a lot of this move has been overdone to the upside, and
Mhm.
you're starting to get back to some normalization here with some of these travel names, because I just have a hard time, even though you're starting to hear from some of the other names out there, Marriott's, starting to hear from the Hiltons, that their booking numbers are starting to go up, which is good. I mean, we do want to see that. But I don't know if it's good enough to say that the bottom has been put in on the travel and leisure sector. And so when you look at a company like Hertz, um, they're absolutely part of the periphery of those names, because if people aren't traveling for business, then they're not renting cars. And what does Hertz get stuck with? Hertz gets stuck with just an enormous inventory of cars that, if they're not going to be rented, they need to be sold. And right now, you're probably not going to get 80, 90 cents on the dollar for these cars, but yet people are willing to pay a premium for shares, which is I guess what I'm having a hard time wrapping my head around is, if that the divestable assets, which at some point look like they will have to be divested, if you're going to get pennies on the dollar for those, then why are you paying a premium on the stock? All right, I don't know. Do you think we covered that one enough, or should I continue my
Yeah.
rant?
No, I think we got it there.
Okay. All right. Back to the overall markets here. Sorry about that, everybody. All right, let's get to the S&P. So, I got to tell you, Rob, when
Mhm.
I saw the futures this morning, I was looking and I was like, I don't like that. I saw the futures were up 80 points, and my initial thought was I'd rather see them down 80 points. Now, let me explain why. We talked about this idea of watching the tape, right? What I wanted to see is I wanted to see a flush. I wanted to see, maybe push down towards this, right around where these lows were before that we saw, right around 29.50 or so. That had been the range that we broke out of, and we broke out of it pretty quickly mid-May, and got all the way up to 3,200. I kind of wanted to see us go back and test that in the morning, and I wanted to see if buyers would step in. I did not want to see us pushing up higher in the morning, only to allow, some liquidation of some of those shares. I wanted to see it the other way around. I wanted to see a flush out in the morning and a rally in the afternoon. We saw a big push up in the futures in the morning, flush down. I will say this, though, we held the 200-day moving average as of right now at 30.13. We're trading 30.33. It looks like we are holding that 200-day moving average. But to me, I think it's more important to kind of keep an eye on that support around 29.50. That would be an area that I'd be paying attention to, even below that 200-day. I know that the technicals will come in, and the arbitrage will kick in around that, or the algo, excuse me, will kick in around that 200-day moving average, and kind of vacillate around that. But for me, this level right here, this 29.50 or so, that's an area where I'm going to be really keeping my eye on in terms of the S&P. Hey, quick question for you.
Mhm.
Are you starting to see some substantial revisions in terms of maybe 2021 outlooks for profits at this point from your end? Are you guys seeing that yet?
Yeah, I mean, we've seen, a lot of uncertainty in terms of, earnings because we're not getting much guidance. A lot of companies, I think a third of the S&P 500 pulled their guidance, so still pretty uncertain. And yeah, they're, they've ratcheted down expectations, but I am starting to see, pretty dismal figures forecast for this year, but a rebound being projected for next year. But yeah, it's still, I mean, it's nobody knows what level we're talking about when we talk about we're going to rebound in earnings. So we got to get some more clarity from that
Yeah.
standpoint to
No,
really
that
get
makes
some,
sense.
some solid forecasts.
That makes a lot of sense. And here's the reason why I bring that up. I'm going to draw in some lines here. I love drawing in these little segment lines. But the reason I bring that up is really this. As I'm looking at the market here, and it looks like we kind of potentially broke out of this upward triangle or wedge, if you whatever you want to call it, that we kind of have been moving up in really since we put that March bottom in, right? Looks like we're heading out here, and that is where when yesterday's high was basically the bottom of this wedge, and we'll see if we can rally back into it, test it again. I don't know, but from a fundamental standpoint, let's say we're going with some of the range of expectations for 2021. All right, and I'm looking at forward earnings as opposed to 2020 because I'm not throwing them. I'm not throwing those out the window. You still need to pay attention to them. But as you said, Rob, there's no guidance, right? So how do we, and are we just going to discount this year's earnings, and say, well, given the environment that we're in right now, we're just going to have to kind of look forward, which I do think a lot of analysts are doing at this point. So I'm looking at the range of earnings that I've been reading, that I've been seeing from analysts, and you see anything from 120 to say 140 on the high end. So let's kind of shoot for something in the middle. Let's say it's 130, right? Which is substantially lower than where we were last year, around 170, 175 at this time. Okay, so if we're looking at a current market trading at say 30/20, and I divide that by 130, I'm looking at a 23 times forward earnings. So I'm still not seeing a ton of value here. Where I know even in 2 days where you've seen the market pull back say 7%, which you would hope to see some people kind of stepping in and say, okay, well, this makes some sense. I'll look to buy some of the dips. My question to you is, are we in a buy the dip or sell the rip environment right now? Like, do you think that there's enough value where some of the value players will be buying some of these dips?
Well, I mean, we definitely saw that the last couple of weeks, the 3-week rally we had. We saw towards the end of it, some of the sectors, we're getting more broader participation on some of the value plays and cyclically natured sectors as well. But we had been mentioning for quite some time that the stock markets are pricing in a V-shaped recovery, but the economic data has yet to show any signs of that. Even the Friday's surprisingly strong labor report, had some caveats to it in terms of reclassifications on the unemployment rate, how they collected the data, and so there's still some uncertainty there. So, yeah, I mean, I think this week showed that, that maybe a little change in what we've seen recently in terms of sentiment, in terms of, buying on value plays and maybe selling some of this. Maybe the stock market's got a little bit overplayed, overextended there, and then they're taking some risk off the table.
Yeah, no, that makes sense. And I'm loving some of the comments that are coming in right now. I told you guys I want you to be vocal today. So I do appreciate the comments. Kyle from Arizona says, hey, Joe, the long hurts trades work, and so trade what you see, not what you know. It's your team's words. Okay, fair enough. Fair enough. Uh-oh. Looks like we got a little bit of a bounce here in terms of my trading software, Edge. Okay. Let me try to bring up another page here. Can you guys still hear me okay, Rob? You good? You still there?
Yeah, we got you. Yep.
All right. Let me hop back.
Yep. Yeah, everybody looks like Joe's experiencing some technical difficulties there, and we're going to hop to a quick break, try to get him back online, and then we'll get back to you as soon as we can.
We are back, and I want to get to Rob. I want to get to some of our commentary here on the week that was, and what you heard from some of the Fed speak. We got some questions here along the lines of, hey, what happens with this trillions of dollars of injections by the Fed, and at what point does that matriculate into the economy? Because we've seen the money supply go up, but we haven't seen the velocity of the money go up because it hasn't really made its way through. At what point do all these cylinders start ticking back and forth?
Well, yeah, we need to. I mean, we've seen figures. You mentioned the velocity of money. That's one thing we're keeping an eye on in terms of, when we do see a lot of big spending from a monetary policy stimulus or fiscal side, the concerns rise that inflation might be, around the corner. But at this point, you'd mentioned, and we see a pretty low risk of inflation in the near term right now, and partly due to that, what you had mentioned, the velocity of money, which is, showing that, although money supply has ramped up huge, actual velocity of money, which is the number of times $1 is spent to buy goods and services per some unit of time. It's actually ticking down, which tells us that banks are holding some of the liquidity there and kind of beefing up their balance sheets there. And then once we see maybe some progress on the economic reopenings, business activity start to pick up, and we get some optimism there, consumer spending wise, then we might see the velocity of money start to pick up, and that could lead to some inflation expectations rising. But yeah, right now we see a pretty low probability of inflation, partly due to the velocity of money, and then also we got some pretty good slack in the economy and a lot of industries there that we need to chew through and get through before we start putting some pressure on upside inflation expectations.
Yeah, I guess my question, and the reason I brought up the 10-year yield here is because, I mean, this thing's had a wild ride over the last couple of days. I think, last week you and I were talking about pushing back up towards 100 basis points, around 1%. And then within a week, we basically gave all that up with Chairman Powell announcing on Wednesday that, look, they're in no hurry to move rates. There's not going to be, we're not going to see a taper tantrum more than likely, like we did in 2013. I mean, basically, they are holding steady, and they are kind of seeing where the economy unfolds all the way through 2022. So what does that mean? That means that you basically saw the yield curves really start kind of flatten out in some of the mid to later years. Here the 10-year got back down to now we're at 70 basis points today off a little bit of a rally. But it really had a detrimental effect on financials. Last week you and I, were looking at as we were rallying into the 200-day pull back. I mean, financials basically for the week are down 13%. I mean, these are pretty substantial moves, and I mean a lot of that has to do with the conversation that we heard on Wednesday, correct?
Yeah, absolutely. The Fed came out and, as expected, kept their target interest rate unchanged, but they offered a little bit more of a gloomier outlook than some may have expected. And also, comments from Jerome Powell discussed, that they're gonna, like you had mentioned, keep rates near zero until through 2022, and then also, keep. I think one of the things that surprised the markets too is they're going to maintain their at least the current pace of their asset purchases. So that kind of took the markets a little bit off stride there, because heading into the decision, we had seen some of the purchases kind of decelerate a little bit. So going into it, we weren't probably expecting them to say we're going to continue at the current pace right now. So that was one of the bigger moments of the Fed's decision. Also, Chairman Powell didn't go into much detail, if any, on targeting the yield curve, which some had going into the meeting expected bigger discussion from the participants. So, that was definitely put. You could see the coupled with what we saw with the concerns regarding the second wave of the COVID-19 pandemic, as new cases were being reported, in Arizona and Texas there, coupled with that, and kind of sparked some flare up in risk aversion and some flight to safety. And we saw that in the treasuries, and we saw the U.S. dollar, which had been sliding as of late, because we've been getting some optimism out there regarding the reopening progress, but the U.S. dollar started to regain some of that footing as well. So you can tell that the risk-on sentiment faded, and started to see some buying into some safer assets there.
I'm going to bring up the weekly performers here. So, you and I talk about this quite a bit on Fridays, is we kind of want to show, weekly performance. And so I'm looking at a 5-day close. And so guys, this is a 5 trading day. So basically look at this as a 1 week. 20-day would be basically a 1 month. And you can kind of see, I mean, with these are the sectors that took it on the chin a little bit: energy, industrials, and financials. And these were the ones that had been beaten up previously, right? That had, made these real substantial comebacks. But they kind of, gave up a lot of those gains here just this week alone. I mean, you got the Dow's down, what, 7% for the week? S&P's down about 6%. Nasdaq's holding in a little bit firmer, down about 3% for the week, and you can see that IT has been holding in a little bit better, as has the communication services and staples. And these were really, if you look at these three sectors, these were kind of the three sectors that it had held in February when the market really started to kind of pull back a little bit. I remember having these conversations with Liz Ann and talking about, we really kind of have a market where it's driven by Clorox and Walgreens, and then driven by Facebook and say the other IT names like Netflix or communication services, I guess, but Amazon's and things like that, and so that's not what you would and Microsoft, excuse me, yeah, that's not what you would normally expect to see from a healthy market. We got those big deviations between the sectors that are performing and the ones that aren't, especially under normal market circumstances. We started to see it again. And I know last week when she and I had spoke, she had mentioned that she's starting to see some of the complacency from the investor sentiment that is starting to mirror what she saw at the end of February. And sure enough, we saw some of that kind of take roots this week with the pullbacks that we have seen, to the tune of, like I said, 7% in the Dow, 6% in the S&P, and about 3% in the Nasdaq. Now, we do got to put this in terms of where we came from, right, Rob? I mean, we're basically at 40% from the March lows, right? And you mentioned this in your little write-up that I mean, look, this is off a 10-week rally, right? So when you factor in the fears of a resurgence in the coronavirus pandemic, you factor in some bearish comments from Fed Chair Powell. We didn't even get to what I was hinting at a little bit earlier from the head of the IMF, Geeta Gopinath. I hope I'm pronouncing that correctly. Basically, she said that the global economy is recovering more slowly than expected and faces what she calls significant scarring. And according, this is from Bloomberg, she said that the IMF will release updated growth projections on June 24th that will likely be worse than their April projections for a global contraction of 3%. So in April, they called for a global contraction of 3%. Now they're calling for something even worse if coronavirus continues to linger and continues to slow down the world economy as it is. So, these are all things that you factor in off a 40% retracement from the bottom, and it's going to create a bit of an overhang for the market. That just makes sense. Now, like I said, for me, what I'm going to be keeping an eye on is the response over the next few days. Are we buying dips or selling rips? On a day like today, it looks like we're selling rips. When you see that momentum, so I'm going to go back here to the S&P real quick. When you see what we saw this morning in the S&P on a daily chart, let's take a look at this from an intraday chart. So let's look at this on a 15-minute chart, excuse me. Basically, here's what happened. This was yesterday. We had that steady move all the way down. We ripped up, and then throughout the course of the day, anytime you got a little bounce, it was sold. Getting another little bounce here. Let's see if it gets sold again into the closer in the last few minutes. But that's not a healthy tape, and it's not healthy because of the fact that you'd rather see that momentum start the other way. You'd rather see the flush out in the morning and then the build up afterwards. I will say this though, I'm looking at the RSI, and the RSI is building into the close a little bit, so that's a little bit more healthy on an intraday chart. But just some things to consider when you're looking at what the markets are telling you from a technical standpoint. What else did you see this week, Rob, from the macro economy that you think our viewers should take note of?
Well, we continued to see, inflation figures. We had the consumer price inflation, wholesale inflation, and import price inflation. All of them are remaining very subdued there. So, no worries there from a Fed change of policy standpoint there. That's they've made it real clear that they're going to continue with their extremely unprecedented monetary policy until we get a return to their objectives of maximum employment and price stability. So those figures came in and they were pretty subdued there. We saw the jobless claims figures as well, although continuing to moderate. They've kept decelerating, but they're still remaining, painfully elevated. A 4-week moving average of continuing claims is still around 22 million. So, got to keep an eye on that figure to kind of get an idea of, we're starting to see workers that have been furloughed or laid off and coming back into the labor force. So that was another data point we took a look at. One other one I saw was business optimism. Small business optimism for May was a little bit better than expected. So that was nice. A nice data point to go with last week's strong labor report. That the small business is a pretty critical component to employment here in the U.S. They employ a large portion of our workers. So once we see optimism start to continue and gain some momentum there, that could be a good sign that the employment picture could be improving there. So those were the main data points. We talked about the Fed kind of had the dovish tone, kind of took the markets a little bit off their game there. And then, but the biggest thing I think was, like Liz Ann has mentioned for some time, that, when we got up to those lofty levels and that froth started to rebuild, it left the markets pretty vulnerable to a negative shock there. So the biggest one I thought this week was the reporting of new cases of COVID, across some of the key regions that have been reopening. So that kind of, heading into this week, we were, pretty optimistic regarding the progress of the reopenings, and this kind of made the markets kind of pull back and reassess a little bit here. So those were some of the main drivers this week.
Yeah. Well,
and
no, go ahead. Sorry. Go ahead.
Yeah, and like you'd mentioned, we saw, the sectors the last couple of weeks that were leading the way, the cyclically natured, energy, industrials, materials, and then you have the financials were rallying. That was a pretty good relief or sign of relief there, that we're getting some broad participation, and it was starting to show signs that we might be able to, at least carry on, maybe go sideways, but maybe potentially continue to rally. But coming into this week, once sentiment shifted from going from a risk on to more of a a cautious or a risk off sentiment, we saw those same sectors like you had showed before. They were the ones that led to the downside this week.
Yeah. What about next week? What's coming out next week that we need to be paying attention to on the economic front?
Yeah, on both the domestic and international fronts, are going to be a big focus on monetary policy. In the U.S., we'll have Chairman Powell's 2-day congressional monetary policies, the semi-annual testimony in front of Congress. So you saw how the markets reacted this week. Every word that he says, the markets are paying close attention to. So that's probably going to be the headlining event. Keep an eye on that. We'll also get May retail sales to kind of get a gauge of how consumers are feeling as the economy slowly start to reopen and businesses start to reopen there. So that'll be a May data point to keep an eye on. We'll also get some June regional manufacturing reports out of New York and Philadelphia. That'll be a good timely read on how business activity is progressing here as the U.S. economy starts to reopen there. We'll also have some housing data to keep an eye on. The June home builder sentiment from the NAHB will be coming out, and then we'll get construction activity on the housing front and building permits and housing starts. So that'll be something that could garner some attention, and we'll get the jobless claims, the weekly figures there. We'll be digesting that and scrutinizing that, all the components within that. And then, the leading indicators will also come out. So we'll kind of get a gauge of where the trend is right now and where it's going. So that's from the domestic side. I mentioned internationally, we have some monetary policy events as well. We have the Bank of Japan's going to give their decision, as well as the Bank of England will give their monetary policy decision. So those will definitely have the potential to foster some market reaction there. China will have some data points coming out as well: industrial production, retail sales, and new home prices that could garner some attention there as well. So, pretty heavily still remaining focused on, monetary policy, global monetary policy on the next week. And as we saw this week, could have, pretty big impact on the markets.
Absolutely. Well, as you were mentioning that, I was kind of toggling through some weekly charts here because Joel from Texas brought this to my attention. He said, "Hey, Joe, you need to go through and take a look at all these indexes because a lot of them are showing bearish engulfing on a weekly index." And two of the four. Let's go back and take a look. Start off with the S&P 500. So here we go. As much as I could draw the rectangle around here, you can kind of see this is the bearish engulfing where you got the red candle that is engulfing the entire green candle. So it's not the wicks, but it's the actual body. So the body is engulfing the other one. Tends to show you that momentum has changed. Right? We did start off here. We got to a high that was above the body of the previous week and sold off where the low. The closing, at least from within the next say 18 minutes or so, looks like it should engulf the low part of the previous week. That is what we call engulfing. So it tends to be a bearish signal, just like this was a bullish signal where you had the bullish engulfing back here on the weekly candle. Now we have a bearish engulfing here. So it tends to portend that the momentum could be changing from the bullish moves that we had seen recently into potentially a bearish move here in the underlying S&P 500. Now, if you look, I went through the four major ones, and you didn't see it on every one, right? So the Dow, not quite. The Dow has staged a bit of a rally here through the end of the day to kind of get outside or back, better ways to put it, is back inside of the that candle. So it's not quite engulfing because right now the close for the week is above the close for last week. So that would not be considered engulfing. So the Dow isn't quite there yet. I took a look at transports because I thought that might be the case, but no, given today's move that they've had up 2% on the day, they're a little bit stronger today than some of the other sectors just because of the fact that they've been oversold quite a bit, right? It looks like at least heading into the close here, they're trying to capture the inside of that candle, so that's not going to be quite engulfing. We did take a look at the S&P. Let's take a look now at the composite, the NASDAQ. As you can see, once again, the rally here throughout the course of the day has kind of pushed it back up above this engulfing status, so it's now within that candle, so that's no longer the case. But the Russell is. The Russell is engulfing. You can see that there's a lot of negative engulfing right here in terms on the bearish side, right? I guess negative means that that you're long. So, right, if you're short, you probably like something like this. But see this, and basically what it's telling you is, with last week's candle where we opened up, we pushed up to new highs. This is where we opened in the week. We opened the week above the previous week, so that's engulfing. And then it looks like we're closing this week below the close of last week, or below the open of last week, excuse me. And so that would be bearish engulfing, which tends to, it doesn't always, but it tends to signal that that there could be some bearish activity up ahead for the next few trading days or weeks or wherever that might be. But that is what we're looking at from a chart perspective. Robbie did a nice job telling us what to kind of pay attention to from the macro perspective. And, I really, really enjoyed everybody's comments today. You guys, you guys came strong. I got to tell you, really good comments. I apologize for my technical issues here. As all of you are aware, we are working remotely, and I feel I truly apologize that we're not able to have the video component that we did before. We're going to get back to that, guys. We will get back to that. We got to make sure we get everything secured in terms of what we can do from a technology standpoint. I want to get this experience back to where it was before. I want you guys to have that connection that you're watching us. We're at our desktops. You see what we're doing. We're having a conversation with you. You can see us talking to you. I want to reestablish that connection, literally from a technological standpoint, but also from how we interact with each other. I hope that's coming soon. We do need to continue to work things out in terms of technology behind what we're doing. But I do want you to know that that is something that we are absolutely hoping to implement within the next couple months, is to kind of get back to that full video feed. So, you guys can, get interact with us more. It's extremely important to us to have this engagement from you, this interaction from you. Why? Because the bottom line is we want to make sure that what we're presenting to you on a daily basis, the financial news that we think is important for you to be digesting, is relevant to you as a viewer. I mean, Rob, you and I have our own ideas on what we think is important, and we're especially in my case, I'm not very shy about sharing those ideas. But the bottom line is if it doesn't resonate with you guys, if it's not something that you enjoy hearing, or if it's not something that you think helps you out, then you need to let us know that. I mean, and so please, continue with the engagement, continue with the interaction. It makes us better, right, Rob?
That's right. That's right.
All right. Well, Rob, as always, you make me better. You complete me. So thank you for all that you do. You are it's great to have your insights every Friday, kind of helping us wrap up the week that was. I will be the Fab to your Rob any week, any Friday. But anyway, you have a great one, my friend.
Yeah, thanks for having me, Joe. And we can't blame it on the rain as of right
Yeah,
now.
very well done. Very. I was wondering if you'd pick up on that reference. Very nice.
Oh, yeah.
Very nice. All right, guys. Thanks to all of you for tuning in. This is the last show of the day, last show of the week. It looks like the market's trying to catch a little bit of momentum heading into the close here. So we'll see kind of what that looks like. But I'm looking forward to seeing and talking to all of you again on Monday. I'll be back for Liz Ann Live. Check that out at 1:30 Pacific, 4:30 Eastern. But then, of course, as always, the first show of the day will be Trader Talk, and that'll kick off Monday morning, 10 Eastern, 7 Pacific. I hope you guys all have wonderful weekends, and I hope that you understand, that we mean everything we say. Like, look, we do this because we enjoy the interaction, we enjoy the engagement, we enjoy the opportunity to work with you, our viewers. I hope you all have a wonderful weekend, and I'll talk to you Monday. Goodbye.
You could think getting commission-free trades is as good as it gets, but you know better. At Schwab, free means more.